really what sets the baseball analogy apart from the investing, which is that in investing there's room for creativity. In baseball, it's very straightforward. You know what a player could do, and you know what they potentially could do. You know what the range of outcomes are. But in investing, when you could find something hidden, when you could think about a situation differently than the market is thinking about it, then you have a real advantage. And I think it's easier to speak anecdotally about it. A couple years ago, Google was trading basically at a discount to its earnings power plus growth value. And it was not necessarily dirt cheap, but it was very cheap on if you normalize their operating earnings. Meanwhile, Facebook is coming public to a lot of hype. It's got a lot of pressure on Google because people think, oh, what could Facebook take away Google's business? And then when you get to thinking like, well, what assets does Google have to compete in this more socially geared world? And you think like, well, there's YouTube. YouTube is the second most popular social network, if it's defined that way, in the world. It's got the most captive audience. Its cost of content is negative. People willingly give them content for free, while you also have Netflix paying through the roof to get rights to content 5 years down the line. And you start thinking about it, well, I could buy YouTube for free. I basically buy Google, and the entire upside in Google is the performance of YouTube. And I think reasonably at the time, I wrote a blog post about how I thought YouTube in its own right could be a $60 billion company. And that was basically a $60 billion call option on top that had no actual value. And a lot of that came through the fact that YouTube itself wasn't segmented out from Google. And so a lot of people didn't really want to think about how YouTube could monetize and what YouTube was worth in its own right, because it was just too hard. And I think Google purposely tried to hide some of that information. So the real key is trying to think creatively about the situation and find these areas where there are actually hidden sources of value. Howard Marks likes to say, recently he wrote a memo about it too, that when you look at any investment situation, you want to ask yourself, what's the mistake the market's making? And there are a couple ways that you could think about what the mistake the market's making, and one of the best starting points is to try to work backwards and find out what the market's implying about a stock's growth, about its cost of capital, about what the average investor out there is thinking. And the market, the markets are humbling. They're mostly right. I like bashing the efficient market theory because I don't think it's entirely right, and I think it's been misappropriated. But most of the time, markets are right. So you really have to find this way to think creatively, to think differently, and to find some sort of way where you could take a contrarian perspective on a situation in a way that's distinct from how the market's approaching it.